Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by JK. JK, how are you, mate?
Good, mate. How are you?
Yeah, I'm not bad. I still struggling with the winter weather, to be honest with you. I've actually got no garage at the moment, so I'm parking the car outside and frost on the windscreen, both windscreens out there with the water, and I'm like, I haven't done this in a long time. But it's good. I guess it humbles me a fair bit. So, gloves, beanies. Melbourne gets cold. Maybe I'm not here enough for the winters. Maybe that's what it is.
I reckon that's what it is, yeah.
What are you doing? Aren't you my financial advisor? Why am I here in winter? What have you been up to? Obviously, baby on the way.
Yeah, baby on the way. And I've just been working on the house really on the weekends. That's about it.
So where are you up to at the moment?
Laundry. So just needs a bit of patching now and ready for the cabinet maker to go in. Yeah. So it's almost there.
I see some of your work that you're doing there, and I need you, mate. I need you. All right, so don't.
I was telling Anthony the other day if I'll build the house for you once I'm done. If you haven't found the right person,
perfect.
Too easy.
We've got it on record, so we'll go there. One of the things that I want to speak about today is something that I've been seeing, not just recently. I've seen it for nearly my whole career, and that's the inconsistency in investing and the cost of inconsistent investing. And what I mean by that is a lot of people will invest for periods of time, similar to like how they'll go to gym for periods of their time, but then seem to kind of fall away. Yep. And what's been your observations between the people that are consistently investing from a behavior perspective, but also what does that look like long term for them financially versus the people that you've seen that call it in?
Yeah, that's a good question. The people that are inconsistent, I would say it's a lot of, they've gotten to a stage where, we might have been planning for something or something unexpected happens. And it could be the case that, I don't know, they were going to buy $1 million for a house and then they went to 1.1 and then, they had to go, we're going to pause it for a little bit, and then they get comfortable with pausing it. Their cash flow starts going elsewhere, it goes to their lifestyle, and then all of a sudden it's just like, we'll put the investing on the back burner until we've got more surplus again. And then it kind of just never happens or takes a while to happen again. I think the other one of it is some people might just give up after a little bit. Like they might have, something happen that affects them for 6 months, and then it's like, well, just stop it or sell up this too hard basket, and then they just forget about kind of the bigger picture.
How do you try to stop someone from tinkering when events like that happen?
It's very hard, and
from what perspective is it hard?
It's more because, like, depending on what's going on, depending on what's happening, they can be in a scenario where they feel like they're never going to get out of it. And doing whatever they can just to solve that pain right now is so much bigger than the bigger picture at that particular point in time. And it's very hard for them to look 3, 4, 5 years down the track to go, this is a shorter term thing I'm going to get out of this. So if I can push through this and stick with this plan, I'm going to see the light at the end of the tunnel.
And for the ones that do stay consistent when change happens, what are they doing differently?
I think it's more of a mindset thing than anything else. So it's the ability to go and having that courage of going, well, yes, this is really hard, but I'm going to push through. I'm going to try find another way to make this work. So it's not to say that they treat it as if stopping that investment strategy is not an option. So if that's not an option, then they'll find another way to do it.
I do see my investments as like a tax that I pay. It's like a future tax that when it comes out, it's just consistently happening. I know you're very involved in my financial affairs, and when we do them, there's this constant like, this is what it is.
Yeah. It's an expense on our budget. Like it's not like a savings thing. It's literally an expense item.
So a question like, I question, I've done this many, many times before, is around when that deviation happens or that challenge happens in the person's life, is to really go down to the crux of really why they're investing for. Because people forget. They forget what they've talked to you about. They forgot what they talked to me about. But we've done so much work in regards to finding out what they actually want. And as JK said, you know, you want to stop the pain now, but what does that pain mean for that future goal? Oh, well, stop doing that and you're going to be working for 10 more years.
Yep.
You know, you told me that, you know, your father died early and you want to make sure that you know, don't work until you're 60. And I want to, so all of those things, what does it mean for those goals? And the probability of those goals starts to evaporate when we start to deviate from the plan, because the plan was formulated to create the highest probability of those goals happening. So I very much bring them back to their goals, but around the goals that mean something for them. They can't be surface level goals. It can't be just as simple as I want to retire when I'm 50. Why? Why is that important for you?
What are you going to do with the time?
Yeah. What's the meaning? What is there? Like, why are you waking up every day to do this? And so I find that a lot of people that stick through it and find a way, like you were saying before, are fully invested in their goals. They really want them to happen. And I say to people, like, most of the goals, if not all the goals, but I just want to put like maybe one or two, maybe, I'm not sure, that I've put my mind to and I really want, I achieve. And I know a lot of people, I speak to a lot of people, I even speak to you about this. Like, if you really put all of your energy into it, you'll get it. So, you know, it's around reminding yourself how important that piece is to achieving that goal. But also is around people that you don't work with. I constantly hear it. Oh yeah, I was investing, but then got a mortgage, and I also think there's a piece around not having a strategy.
Yep.
You know, it's like investing for the flavor of the month. Do you see that?
Yeah, I definitely see that a lot. And I think that also comes to one, like you said, about not having the goal in mind, because it's that goal that's going to help create the consistency. But also not invest, like we see a lot of investing happening because people are trying to chase like shiny objects or the next best kind of investment phase that's happening, or, you know, there's this particular thing booming and they're just going into that. Then that kind of doesn't go their way. And then all of a sudden it's like, oh, I've just given up on investing because that strategy, which was based on hype and emotion, not logic, just all of a sudden stopped working.
It takes a lot for us to really train that behavior out. Yeah, I find that, like, as humans, we're just constantly trying to like excite our finances up. It's very difficult for us to kind of train that out, if that makes sense, because you're constantly like, oh yeah, but my mate's earning this and blah, 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 blah. And, you know, the world keeps on talking about their winners, not their losers. But like when we're consistently seeing the data and the facts, it's not chasing the shiny stuff. And we know from like years and years and years of results that it's just this constant sticking to the plan. You know, when times get tough, reminding yourself of the goals, bringing yourself back to them.
And that's actually a really good point too, because another thing that also stops people being consistent is when they're maybe not doing as well when everyone else around them is doing really well.
Yeah.
So if you're, I don't know, you got a particular like boring investment strategy, index funds, regular contributions every month going into that investment, and then all of a sudden you got three mates around you that are all investing in Bitcoin and they've all earned double in the last month, then it's going to be very easy for you to go sell that, go into that other thing, and just doesn't work out, and then you've given up on the strategy that you had in place at the start.
Well, there's been two clients that me and you have worked with that are no longer with us.
Yep.
That chased shiny objects. One was very wealthy. The other one was wealthy. And the latest one, the wealthy one, not the uber wealthy one, we were talking about this the other day, you know, sell everything, sell all the boring stuff. I'm going to kind of go and invest in highly speculative stuff because I know.
Yeah.
And he told us what he was going to do. He's lost a lot of money. He's lost a lot of money. Now, we didn't know he was going to lose a lot of money. Like, then we're talking probably that happened about 12 months ago. But when things sometimes become easy because of this proven process that happens, this overconfidence bias starts to creep in.
Yeah.
Which is like, oh, have a look at me. I stuck to the plan. We're exceeding the plan. We're doing, well, let's just take it one step more.
Yep.
Let's just take it one step more. Let's just take it one step more. And we are constantly telling people, like, when you're doing really well and you're exceeding, please remember that these aren't going to happen all the time. And so, especially in today's society where you've had this kind of really upswing in markets, especially in the stock market, and not much downturns, you kind of go, well, just go, let's go more risk, more risk, more risk, more risk. But really, we know that when it's raining, put your cup out, fill the cups up, put some in war chests, take it off the table, put it in war chests, stick to the plan, because when it crashes hard. And the uber wealthy guy, similar scenario. You know, I still remember this was probably 2 or 3 years ago now, and taking out everything, world's going to end. You know, took out everything. Majority was put into physical gold at that point, and don't get me wrong, gold's done relatively well, but you know, no dividends, no nothing. You know, these new federal changes going to massively affect this guy and the way that he has to kind of deviate his stuff as well. And I look at all of our success stories and I'm super proud of them. But because of this perfectionism in me, I constantly think about, like, why did they fail? Why did they not be consistent the way through? What did I do that I could have done better? And I've had to come to grips with over the years that I can't save everyone. You know, I can't.
Yeah.
I used to think that everyone I work with I can save, but there's obviously this, or help, but there's this, it is a partnership. You know, I can do as much as I can. I can lead the horse to water, but the horse has got to drink. And if they're not willing to open themselves up and essentially make their finances boring, then they're going to just continue to go back to where they. And I know it's not easy for some people. I know it's not. And there's things that we can do, but not being consistent is a massive killer in regards to people's finances. And like with anything, you know, if it be sport, if it be whatever, how many people you know that have amazing talent in sport, but lack the consistency and never make it somewhere. And then you got the guy or the girl who's average, consistent in her training, consistent, and then she makes it or he makes it to the top leagues. Yeah. You see it all the time. And this is the same with...
Would you say there's anything more important than the consistency?
Yeah, I think there's, you got to have consistency, but you've got to have the willingness and the eagerness to learn. And because, so I think there's a few things when you talk about like investing and / being successful. I think like if you put them together, one, you need to be curious in regards to what's beyond you. So what I mean by that is around, if you're in an environment where you think that is the standard, that's all you'll work with. Okay. And so if you were in a family that never invested, you just saved your money, you bought a house, paid it off, that will be there. And so consistency in investing for that person is consistently putting money into what their parents did, for example. So curious. 2 is around learning. Learning is 2 parts. learning in regards to your own self-development,
Mm-hmm.
and then learning from people that are much more successful than you. Okay, so there's that learning element to break through those ceilings. But the learning, the growth personally, coupled with the consistency of sticking to the plan is huge. You know, there is that many people that have plans, personally have their own plans. I'm going to do this, but none of them execute.
Mm-hmm.
So you've got this kind of four-pronged kind of attack. So to answer your question, yes, it's very important. It could be argued as the most important,
Mm-hmm.
but I think it needs to be combination with the others. I think it's this attribute of being the successful investor is about being consistent.
Mm-hmm.
And this is where I know that the boring stuff creates the highest probability of you being consistent, even though you don't think so, because it's actually easy. And that's the thing, like people look for hard. And so that's where I'm talking about the learning aspects. It's around you need to learn to be comfortable in some things and uncomfortable in others. Active investing.
It's an interesting one. I think it's a little bit of this, or it can fall into this inconsistency / consistency that we're talking about.
So I'm consistently actively managing because you can be doing that.
Yeah.
What's your view on that?
So there's a lot of research that's been done to say over the long term, it's very, very hard to beat these active managers. I think in the US or something, there's only like 15% of active managers that outperform versus the index fund over a 10 to sort of 15-year period. In a 3-year period, it's like 50% or something. So it's a lot more likely.
It's actually 70%.
Oh, is it? Oh, there you go.
Yeah.
There you go.
It's worse than you're saying.
Yeah, okay. So it's one of those ones where I think you just don't want to bank your financial future on, am I going to get the right fund manager? And then are they going to do right, good enough for long enough where this is going to be worth my time, effort, and essentially extra risk that you're taking in a way as well.
So you've fundamentally changed. Obviously, you've gone from active now to this kind of passive approach. When is active appropriate? Is it appropriate at all?
Well, I think it's a bit, it's interesting. So the active that I will describe that I was doing, because it was more like kind of day trading when I was a lot younger, I'd almost argue that is a source of income. Like I wasn't looking at putting that money away for say 5 years as an investment.
Yeah, it was your job.
It was more like a job. Yeah, it was sort of like a side hustle, I suppose, at that time. And so I think you've kind of got that active, but then you've got the other active where it's like, as part of your long-term investment strategy, you are going to take that active approach where you're deviating asset allocations, you're potentially picking particular companies to perform better with the idea to hold them for a longer period of time, not just go in and out in a week or two or so. So I think for me, it's a bit of a sliding scale of active.
I think for me, when you talk about active investing, I actually see the active side on the asset allocation. And what I mean by that is around actively monitoring your asset allocation in line of your risk that you need to take to achieve your goals and aspirations.
Yep.
It's not the active in regards to this stock is the position that I need to take because of X, Y, and Z. I think when you look at it from an asset allocation perspective, you want to be, back to the word, consistent on reviewing the risk that's in your portfolio to achieve the goal and the outcome that you want to achieve.
So it's not purely just say a set and forget, it's predetermined rules that are then dictating the decisions you're making, not new information coming in at a particular point in time and then deciding how we're going to react to that information.
Correct, because that pool of money is constantly being updated. More money in, more money out. And changes in markets as well too. You know, bull market in regards to the stock market, exposure in regards to your share portfolio increases substantially. So I like to be more there, and it's reducing the risk to create the highest potential return. And this is where markets being volatile actually works in your favor.
Yeah.
So we've got active and like obviously passive, but I tend to see that people who are more active happen to be less consistent. Like I don't know someone that's done it their whole life. I know a couple, but very few that actively manage and succeed.
I wonder if that's because of the mindset of you're being active so you can try beat returns, really, if you get to the crux of it. So is that mindset of I'm trying to beat returns always, meaning that you're chasing the next best thing, which is
I think it's
ruining
just
that
fueling a
consistency.
bad
Yeah.
behavior. I think this is where I'm getting at.
Yeah.
It's just fueling this bad behavior where, yes, you're potentially onto your next winner, but you're also potentially onto your next loser all the time.
Yeah.
And this behavior in regards to the way that you view life changes things.
Yeah, absolutely.
And it's just interesting when it comes to that. While we're on that, flip the whole other coin. Talk about consistent investing. What are one thing or two or three things to help people to be more consistent?
Having direct debits, I think, is very important, where it can just happen and you can just forget about it.
Yep.
Because the more you're reminded of it, the more you're going to be tempted to go look at it. Then the more tempted you're going to be to then start comparing. And then the more tempted you're going to be to jump ship or chase a shinier object.
So you want it as automated as possible.
You want it as automated as possible. And like I say to our clients, especially when we're catching up to, review their progress or whatever it is, that sometimes I'll ask them, I go, do you guys look at this often? Like what's the go? And some of them will say, yep, no, haven't looked at it and haven't even thought about it since I last spoke to you. I'm like, good, keep doing that. Don't look at it. So I think it's having it automated, but also not having easy access to it, I think is really important too.
What about in regards to changing their behavior? So people that have maybe found themselves being inconsistent, how do they start to change themselves to become more, I'm going to throw one out while JK's thinking. I think one of the biggest ones is seeing what it means for you. The lack of clarity creates the lack of direction. So a big thing is, what does that mean? What does that mean for me in 1 year? What does that mean for me in 5 years? What does that mean? If I'm going to the gym, I want to see the picture of me with the six pack and I know what I'm working for. I want to see the results. And so if you can't see your 1 year, 5 year, 10 year, 15 years, why am I going to be consistent?
Why am I doing it? Yeah.
I want to try and find the quickest way because I reckon it's never going to happen. So therefore I'm going to take on risk. But if you see it mapped out, well, all right. And then understand that when I've got that in front of me, well, what happens if I add risk to that scenario? All right, well, it might happen sooner, but it might not happen at all.
Yep.
And seeing in front of you the risk of getting it wrong, we call it the red line, I think visually makes you want to buy into being consistent.
Yep.
So I think automation, don't look, don't compare.
Yep.
And when I say don't look, don't compare, try not to be constantly looking at it like JK said, and don't compare with others. Like that's the main thing. Yes, we want to be reviewing your finances, making sure it's appropriate review, but it's not about comparing with others. Yeah, because they will tell you they're winners, they're not going to tell you they're losers.
Correct.
And then the third one is having clarity, seeing what's in front of you and how the decisions by pulling certain levers, the impact that's going to happen on your affairs.
Yeah, I think that's awesome.
Awesome. Well, guys, hopefully you liked that episode. If you're loving these episodes, make sure you like and subscribe on all major channels. Throw us some comments. We love answering your comments as well too, and sharing with everyone. So, JK, thanks, mate, for jumping on, and thank you for watching and listening.
Thanks, everyone.
Cheers.